Hello, everybody. We're delighted to have so many of you here. We've been very pleasantly surprised at the response on these so-called agents of impact calls. I think it's a testimony to folks' desire both to connect and to get things done. So we are happy to play our role in that, and we're delighted to have you all. We're going to try something new in that regard. We're going to leave this Zoom channel open. We've had the feeling in the last few calls that so many great people come together and then split apart. And what we want to do is see if folks want to hang out, kind of like if you were at an event and you just hung out in the lobby afterwards. There's no kind of open space technology here other than the basic Zoom call. So we're not going to manage this in some way except just to leave the Zoom channel open. You can chat in the chat with folks. You can, if you do the drop down menu, as I'm sure you know by now in Zoom, you can find the folks on the call and reach out, or you can just pop up in the audio. I'll kind of hover around and see whether there's any facilitation needed, but I'm going to basically take a step back at the hour. And if you have to leave, just feel free to leave. So that's kind of our midpoint of adopting open space technology. Zulema talked about the Slack channel. That is, we have done something different again in the same interest of keeping folks connected. We've opened up 10 Slack channels in the spirit of 10x. Community Capital has had some activity, system change, and others. So you can go and you'll see if you read the brief, you'll have found many links to join up and select which channels you want to be part of. Let me briefly introduce the folks who are going to be speaking a little bit, and then I want to bring on my colleague Amy Cortese just for a moment. And she's going to help sort of guide the conversation. But maybe when, I don't know, let's see, I don't know whether you'll pop up on the screen or not if I name you. You probably have to say something. But I just want to say that we have Bruce Katz from Drexel's Novak Center Metro Finance Lab. Maybe we won't worry about whether you pop up on people's screen. Fran Siegel from the U.S. Impact Investing. Okay, there you go. What I mostly want you to do is unmute yourself. So everybody, as I call you, at least unmute yourself. So then when we get back to it later, we won't have that problem. Fran Siegel from the U.S. Impact Investing Alliance. Beth Bafford from Calvert Impact Capital. Patrick Davis from the Community Reinvestment Fund. James Beeson from True Fund. Kat Berman from C-Note, and Deborah Schwartz from the MacArthur Foundation. Oh, Darren Williams from Southern Bancorp. I hope I didn't miss anybody. And then there's many of you on the call who are certainly more expert than me, and perhaps as expert as our speakers. And so we're very hopeful that as we open it up in the sort of second half of the hour, you just pop up and share your thoughts. And lots of folks on this call, I scanned the RSVP list, are longtime practitioners and experts in community capital general, CDFIs, community development financial institutions in particular. So we're eager to have your expertise as well. Just on that CDFI question, there was on the call yesterday, on the MIE call, there was a bit of discussion about what a moment CDFIs are having in the current context. Amy, you want to come on and let's just sort of set this up a little bit. Amy's been doing great coverage both of the PPP program and a lot of the other channels as well as CDFIs. Amy, why do you think community development financial institutions been around for 30 years? Why is this the moment?
Yeah, it's funny. I had a chapter in my book, which came out in 2011, about CDFI. Am I not muted? Am I? Okay. Can you hear?
No, you're good now. Yeah.
Oh, okay. Yeah, I was just going to say I had a chapter in my book that came out in 2011 about CDFIs. Can you hear me?
Yes.
Okay. So they've been having a moment for a long time, right? We all know the strong track record. Just let me know. Yes, you can hear. Okay. But I think the COVID crisis, it has exposed so many things, and the vital role of CDFIs being one of them. So yeah, but I mean, I think most of us know they have a, decades-long track record and are really the vital infrastructure for supporting small businesses.
And Monique Aiken said yesterday, the new thing with a 30-year track record. So, so there is, I think, possibly, and maybe this call can help advance this, a need to not quite rebrand, but possibly, sort of elevate the brand. I don't know, CDFI doesn't quite roll off the tongue. Maybe for folks on this call it does, but in the general public. So community capital, I don't know. That's sort of a subtext of this call of how to create more of a popular constituency around this notion of community capital. One last thing is, we have had this kind of 10x challenge, which we cooked up a few weeks ago, and folks seem to be responding to it. We've gotten a little pushback that it's not just 10x capital, and we fully embrace that. It's 10x speed, it's 10x collaboration, it's 10x it's 10x depth, it's 10x impact. So 10x sharing, you can take it however you like, but we will be doing a series of calls in the future that are, kind of framed around that. The notion being, that the crisis is a chance to really show the world what intentional impact investing can do. So with that, let's bring in Bruce Katz. Bruce, welcome. We've been reading and learning from you for years, so we're very happy to have you on one of these calls. And I was hoping you could give us the sort of overview, like how bad is it on Main Street for small businesses, for nonprofits, in particularly, in underserved areas, low-income areas, communities of color, women founders. I don't think we can start without knowing the depth of the crisis.
Well, to tell you the truth, I'm not sure we really know the depth of this crisis, because what this crisis has done is exposed enormous deficiencies in data, in the kind of financial products, the delivery system, intermediaries, support for small business. If you think about this crisis, and we're now moving from the first phase, the rescue phase, the health crisis and an economic shutdown, to the beginning of a reopen and a restart phase. From a day-to-day basis, what do we have information on? We have information about filings for unemployment insurance. We have information about the health system, ventilators, masks, tests. The small business information is not real time. And so what we're relying on really are surveys to get a sense of which part of small business, particularly face-to-face small business that have been dramatically affected by this, particularly those that tend to congregate in main streets and business districts and commercial corridors and downtowns. And then we're now getting information, and this is why the CDFI conversation is so critical. We're getting information about the inadequacy of the federal relief packages that were constructed very fast. So if you think about the first CARES package and the Paycheck Protection Program or the Economic Injury Disaster Loan Program, it's clear that those are delivered in such a way through mainstream financial institutions initially that they tend to serve larger small businesses. Again, we define small business in the US as less than 500 employees, which is somewhat absurd because most people on the street would think less than 20. And so the way in which we delivered the capital initially, underserved, particularly Black and brown-owned businesses, which tend to be very small, do not have these traditional banking relationships, and really rely on alternative lending institutions. So as that got fixed along the way, we're beginning to see the ability to serve this underserved set of businesses. What we're also seeing as we move from rescue to reopen is we have to focus on small businesses and on the business districts where they tend to congregate. So the next package, if and when it occurs, we're in sort of this phony period of everyone's really waiting to see what happens with the restart. Are we going to have a spike in cases? Are we going to have, unfortunately, a spike in deaths in particular places that open prematurely? There's a lot of uncertainty out there, which is going to dampen the rebound of this economy. But I think as we move into the next phase, what you're going to see is the country focus on the loss of small businesses, the death of Main Street in many parts of our communities, which are not just centers of commerce, but they're nodes of civic life. That they're really what draws people to particular places, and it's the way we identify ourselves in different communities. And then I think the possibilities here is both to have a dramatic upsurge in the use of CDFI and alternative lending vehicles as this crisis begins to move forward, but also in different business models, collective business models, intermediaries that are basically bulked up at the Main Street level so they can provide common services, deep cleaning, technology access, back office functions around hiring and financial navigation. I think we're going to come out of this crisis with a different kind of system for community capital and for community regrowth and community wealth building. So
let me stop you and ask you what, because that different system is exactly what we're interested in. What have we learned from the efforts so far, the initial PPP, about the system for distributing capital or getting capital or other resources into the all the way down to the businesses that need it? As you say, you know, most businesses are 20 or less, and yet I think in the initial PPP, you know, a lot of the money went to the larger businesses. At the same time, the second tranche of PPP is not yet exhausted. I'm not quite sure why that is. What have we learned so far? And then I want to zero in on this new system.
Well, what we've learned primarily is that the ecosystem for small business less than 20 is very weak in the United States. We don't have the data that's real time. We don't have the support mechanisms to give individual entrepreneurs and business owners a clear sense of how to access capital. If you think about the US and ecosystems, we have very strong ecosystems on the tech side, right? Think about research institutions, mature companies, startups, scale-ups, angel, seed, Series A, incubators, accelerators. On the small business, local serving side, very weak, very anemic. We don't have that support mechanism. So that's what's happening here. And because we relied on mainstream financial institutions, large banks to deliver the PPP product initially, some carve out and corrections there, very critical. They went to their favored, folks they were working with. So the bigger small businesses basically were first in line when the PPP was rolled out. That's been corrected during the second phase of PPP, but essentially we've already lost a lot of businesses because they didn't have enough capital reserves and cash reserves to begin with. So, you know, politicians and many others mythologize small business in the United States. It's the engine of the American economy. It's basically the path to the American dream. There is no system in this country for basically providing particularly Black and Brown owned business with the kind of mentoring, support, access to capital they need to move forward. So I think we're coming out of this understanding we're not just rescuing a bunch of businesses and hopefully many survive. We have to completely recreate every single aspect of the ecosystem going forward. Or else the notion of growing wealth in this country and reducing racial health income disparities is going to be delusional.
What are the elements of this? I think you've called it a parallel system. What are the elements of that system? You hinted at it earlier, but what CDFIs are part of it, but what else is needed to revamp that system?
Well, again, I think most market systems are based on data. that's real time, that enables you to understand all the different aspects of small business ownership and entrepreneurial dynamism, right? From sector to size to scale to consumer base, whether it's local serving, whether it's within cities and metros, whether it has an export capacity. Our data systems have been found wanting here. The last national survey of small business was done in 2012. That seemed to be a little bit lagging here. So we are lacking for, again, a sector that is considered to be the engine of the US economy, with the kind of nimble data that we can use to understand which cities, for example, are moving forward on Black and brown-owned business, right? Why are they moving forward? Is it the intermediary system? Is it impact investors and their ability to test new financial products that are more equity-based than debt-based? What's the relationship of CDFI from a geographic coverage and the relationship with traditional banks and other potential investors? So we're dealing in a system which, for a long time has been really not the subject of serious academic research, like in the housing sector. You look at the housing sector, academicians, primary lenders, secondary lenders, enormous amount of capital has been put into understanding how this system operates, particularly post 2008, 2009. Small business is almost like an emerging market in the US. It just is not treated seriously by anyone, frankly. And now to a large extent, we are reaping the whirlwind of this. And so going forward, I think this is not just about the next product. This is not just about CDFIs becoming a larger part, as they should, of traditional capital, whether on the debt side or the equity side. I think we will not have an SBA in a year. I think it'll be a completely different federal ecosystem. If we're serious, we don't just need a Department of Pandemics. We need a radically new approach to small business lending, entrepreneurial dynamism, and reducing the wealth gap in this country through business ownership and expansion. So we're in for a very interesting ride here. And I think everyone on this call who's been in on this for a while, this is your moment, because people have been playing in the vineyards for quite some time. And now suddenly it's front page news every day, and will be even more as we reopen and we find our main streets are at 30–40% capacity of what they were prior to the crisis.
Indeed, indeed. Well, thank you, Bruce. That cues up very nicely the role of policy, which I think is another thing that has come to the fore in the crisis. And we have some actual news from even from yesterday that bears very directly on CDFIs and community finance in general. And I was going to rely on you, Fran, to walk us through it, because you've been deep in it. But just give us the headline first, and then the implications.
Sure. Yeah, happy to talk about the Community Reinvestment Act, but also wanted to flag and maybe.
I'm sorry to interrupt. I should have given you a better introduction. Fran Siegel is the head of the U.S. Impact Investing Alliance, which is a convening organization headquartered at the Ford Foundation, but that it has been at the forefront of the kind of impact investing policy discussion. So I apologize for not having brought you up with the proper.
Thank you, Dave. That was sort of like a family table, dinner time handoff, which I appreciate. Yeah, so I'd love to talk about the Community Reinvestment Act, where a new set of regulations broke yesterday, but just to pull a thread through from Bruce's comments, there was a really great quote from Chairman Powell recently. The loss of thousands of small and medium-sized businesses across the country would destroy the life's work and family legacy of many business and community leaders and limit the strength of the recovery when it comes. There's a lot to talk about in terms of policy. I want to focus on CRA, but note that in the phase 3.5 stimulus package, there was a $60 billion carve out in the PPP for community lending institutions, but most that money went to smaller commercial banks. So it meant that CDFIs, even if they were 7(a) lenders, didn't get access to it. And there's a new $3 trillion HEROES Act put forth by the House Democrats, which sets aside $10 billion of the remaining PPP funds to guarantee loans made by CDFIs and minority depository institutions. There's also $1 billion proposal for the CDFI fund. So there's a lot. This is a moment for policy, and I think when you hear from Beth and Patrick later, we need to figure out ways that we can leverage policy and private capital through public policy to get to the scale of capital that we need to serve some of the small businesses that Bruce was talking about. So as most of you know, on the call, the Community Reinvestment Act, CRA, was signed into law in 1977 in an effort to reverse the practice of redlining and disinvestment in low-income communities, especially communities of color. Since that time, the CRA has become really the cornerstone of the community investment ecosystem in the United States, and has been particularly important to the CDFI industry, which grew rapidly over the same period. Just to give to put a fine point on it, Treasury Department did a 2017 study that found that 41% of capital for participating CDFI loan funds came from CRA-regulated banks, significantly more than any other source of funding for CDFIs. And this will come back again when Patrick and Beth talk about the community recovery vehicle, where bank CRA capital can play a very prominent role in getting to scale. The CRA also interoperates with a couple of other existing frameworks, and tax incentives, the low-income housing tax credit, new markets tax credits, which are two major community development tools where CRA-motivated banks are some of the largest investors. So suffice it to say that CRA is vital to communities and the work of impact investors. David, I'll make this part short. There are three federal agencies that regulate CRA: the Federal Reserve, the FDIC, and the Office of Controller of the Currency, which regulates the national banks. So they each have a different piece of the pie, and they all regulate CRA. And yesterday, headline, David, I'm bearing the lead, one of those agencies, the OCC, the Office of Controller of the Currency, moved unilaterally to finalize sweeping changes to the CRA program that we fear at the Alliance and many in the field fear could undermine decades of work and billions of dollars in badly needed community investment of community investment capital. So we believe that the CRA needs to be updated, but not in this way. It's important to note that the OCC went it alone, and around their regulations, the FDIC didn't finalize regulations along with the OCC, and notably the Federal Reserve has completely sat out this round of changes. We issued formal comments, but it's important to know that the time between the end of the public comment period and the final regulations, which came out yesterday from the OCC, was just 6 weeks. It's also interesting to note that a day after those sweeping changes came out, Controller Joseph Otting, who runs the OCC, resigned his position. One of my colleagues called it the consummate drop the mic moment, and indeed it is. But the lack of interagency alignment, so the regulators are, in the worst case scenario, they'll all be propagating different sets of regulation, creates problems for the banks, it creates problems for communities, and we're really concerned about it. So the Alliance, the organization that I lead, will continue to work with policies at the Fed and at the FDIC to offer input on a set of regulations that ideally will promote authentic community engagement with residents in low to moderate income communities, and will effectively draw private capital to those places. What this really means is that the OCC has propagated these rules that will have national banks. There's sort of an incentive because of the rules, encouraging them to pursue a fewer number of larger deals. And we believe the effect will be driving capital away from CDFIs, particularly smaller CDFIs, rural CDFIs, ones that serve tribal communities. and again, draw capital away from the smaller, more impactful activities that communities depend on to do these kind of easier, larger deals, sort of like what, Bruce said earlier, that on the PPP, the big banks lent to folks that they knew where they could shovel out, large PPP deals. And we worry that the OCC, who regulates, again, the national banks, there will be a heavy, heavy incentive to do larger deals, smaller deals, and this can be very deleterious to the CDFI sector and the communities that they serve.
Great. Thank you, Fran. You can all see why we rely on Fran to keep us straight on the policy issues. Thank you. And I imagine folks can reach out to you to get involved in the efforts. So thank you very much. Amy, join me in bringing on. Let's bring on Beth, Patrick, and James together because they sort of come as a package. And maybe you can help them walk through this model, which in a sense responds to some of the things that Bruce and Fran have been raising about how to strengthen the CDFI channel. So Beth, maybe the first thing is to just describe what the problem you were trying to solve, and then we'll get to what the solution is.
Yeah, absolutely. I think as has been mentioned, the problem is that there is a alternative financial system that exists in the kind of community lending, community capital, CDFI space that is built and has been built for a long time to serve communities who otherwise cannot access capital, mostly credit, through the banking system. That system, that alternative financial system has a lot of critical strengths. It has deep roots in these communities, led by people from these communities, has the trust of the communities that they serve, which I think cannot be understated. A lot of these communities have been, for lack of a better term, screwed over by the financial system for a long time. And really need to go to trusted sources when thinking about their ability to either as a consumer or as a business to access capital to go forward. And so there's a lot of strengths of these organizations that James leads and Darren and others that are on the ground and have been serving low-income communities and communities that exist outside of the financial system for decades, as has been mentioned. I think the issue is that they are essentially providing a public good, but have not had access to the necessary resources over the last decades to invest in themselves to capitalize on that public good. So or to kind of to gain access to the resources that reflect the fact that they are providing a public good. The business model is tough. Right? Like if you are providing a $10,000 loan to a small business, that takes a significant amount of time, resources, technical assistance, capacity, systems, technologies, that is not going to be made up by the interest on that loan unless you are charging usurious rates. And so the business model is hard for this kind of lending, which is why I think there's a need for a much more coordinated, scaled, much larger thinking around how these organizations are resourced, to Bruce's point earlier. But within the system that we're talking about, what are the problem we're trying to solve is how do you take these incredible organizations, 1,100 CDFIs across the country, and how do you, in this moment, in the near term, leverage their strengths and abilities to the highest possible amount. And I think there's three things that we need to do that. One is to free up existing balance sheet room. These balance sheets are small and fragile in a lot of places, especially right now, given the assets that they're lending to are going through severe economic strain. So we need to free up and strengthen their balance sheets. We need to leverage every dollar of room on their balance sheets. So we need to think about leverage beyond what they can do on their own. And then we need to invest in operations and make sure that they have the operational capacity, resources to scale up, loan origination, systems, processing, servicing, technical assistance, all of the operational aspects of what a CDFI needs to execute on. And so what we're doing in partnership with many on this call and many others in the field is trying to see what role can we play as a collaborative and within the private markets to kind of turbocharge the CDFI infrastructure, those pipes, and kind of get them to reach their max capacity to get anywhere near the demand that we know exists in these communities across the country. But what we're doing, and I'll turn to Patrick to describe what we're talking about, but what we're doing has its limitations, right? We are working right now within the private markets, and what can we as organizations do without legislative action to boost capacity and to raise money from the private markets to get this money flowing down to these businesses ASAP. But we are also trying to figure out how to make sure government is a partner in this work, because scale cannot happen without them. So I think we recognize that limitation, and it's why we've been working with Fran and others to, and Bruce, and to understand, how we can put these two pieces together. The second limitation or consideration is that what we're talking about right now is around small business assets. We know, like Bruce said, that is only one type of community asset that needs to be served right now, and that CDFIs serve many other asset types as well that make up that kind of community fabric. Affordable housing, community facilities like schools, community centers, health centers, the built environment of our communities, it's also served by CDFIs and needs to be a part of this equation if we're going to leave our houses, go back onto Main Street and have it look anything like what it looked like before we all were forced to stay at home. And so I think that's just another kind of limitation of what we're thinking about. I think the structural elements can convey to other asset types, but certainly something that we understand as we're thinking about these solutions this is one tool, another tool to put in the toolkit of a much broader conversation that, as Bruce mentioned, needs to be happening around how do you rethink the support and resources that are poured into these communities so that we can create something much bigger and much greater than the sum of its parts. And so with that, I'll turn it over to Patrick to describe what we've been working on together, and James would love your views as well.
Thanks.
Yeah, let me just jump in and give Patrick a little intro. I'm Patrick Davis with Community Reinvestment Fund in Minneapolis. And Patrick, you're a CDFI, but you've really also stepped up to this role of service provider almost for other CDFIs. So you have a lot of the infrastructure that could help expand the capacity of the whole field. So talk a little bit about that and your part in this new vehicle.
Yeah, thank you, Amy. So I think just a couple of quick remarks. One, I heard we need to 10x collaboration, we need to 10x all of these things. I think in the CDFI world, one sort of hopeful note, I think we've maybe 5x'd collaboration over the past 90 days. Maybe there's another 5 to go. But we've seen some really fantastic examples of rapid collaboration that I'm not sure that CDFIs have always been fast to move in the past. And we've seen a departure from that in order to respond to the needs. So that's been fantastic. I mean, with respect to the PPP lending, CRF has a national SBA license. We realize there are several other CDFIs around the country that don't have expertise in CDFI lending. We have sourced and deployed $500 million in PPP loans directly from our CDFI partners around the country. I saw we have friends from IFF on the line here. It's been really inspiring to work with CDFIs who have strong relationships in local markets and can refer those customers to us to actually originate the loan, but can play a role on the front end in terms of pre-loan technical assistance to get them prepared for the PPP loan. So I think that's a really concrete and fantastic example of collaboration in the space that's starting to emerge that maybe was somewhat lacking before. So, and then in addition to that, I also want to note that it's not just CDFIs. We need to create this very robust ecosystem that should include development finance agencies, quasi-public institutions, community banks and credit unions. There's a much broader community here that perhaps has been fragmented in the past that really needs to consider how to be better integrated going forward in order to provide the types of capital and the scale of capital that's going to be required. So just wanted to make that point. Amy, to your remarks, I think CRF has absolutely been probably more focused on our role in providing infrastructure, providing access to shared services for other CDFIs in the moment that we're in now than we have been on our own direct lending. And that's really intentional. And so CRF has spent the better part of the past 5 years really building infrastructure that we think can link community development finance organizations together and so in a way that presents the preconditions for scale. So one of the issues that we've seen in the past is just nobody knows what a CDFI is. And we all know this issue, right? CDFIs are, I think would be the first to say we're not the best marketers. We don't tend to invest in marketing. It's sort of the last thing that gets taken care of in the annual budgeting process. So at the same time, we've looked at some of the data from the Fed Small Business Credit Survey, and we've seen some phenomenal things. So in the 2018 credit survey, CDFIs ranked #1 in lender satisfaction scores, above credit unions, above large banks, certainly above online lenders. They ranked #1 in approval rates for loan applications, but they ranked really at the bottom of the barrel in terms of loan applications by orders of magnitude. So to us at CRF, that says there are these phenomenal but really unknown community development lenders around the country. How do we get them exposed to the businesses that really need to be seeking their services and their products? And so one of the things that we created to address that at CRF is called Connect to Capital, which is a marketplace of responsible lending products that are offered by CDFIs and other community development organizations. And so that creates a single front door for a small business owner to apply and then get pre-qualified for one or many CDFI products that meet their need. And so that really reduces this problem of information asymmetry and allows us a centralized place to market the products and the offerings of CDFIs, and to pursue things like unprecedented referral relationships with large $100 billion plus OCC regulated banks that are looking for a responsible, mission aligned alternative for the customers that they're not able to lend to directly. So I think this idea of really bringing together some infrastructure to knit the CDFI community together in a way that creates that network effect and that power and the ability for us to negotiate in a different way than we have in the past with other potential partners, referral partners, or what have you. So I think that's one critical piece on the front end in terms of addressing kind of how do we find the proper customers. Assuming we're enormously successful in that, now we got to address the loan operation side of things. And so how do we make sure that CDFIs have a modernized loan operation system that allows them to scale up and meet the need and realize economies of scale without having to hire a ton of new people, without having to, so how do we look at the back office of CDFIs? And then it's not just the origination process, but from there, loan servicing, same thing. How do we start to realize economies of scale in loan servicing? And then on the back end, how do we now, if we introduce some standardization to the field, it creates opportunities to open up new sources of liquidity. So if we have CDFIs that are originating a suite of standardized products, we can pool those products, we can offer participations to investors, we can create funding vehicles that can then support the deployment of those products at scale that can include both public and private investors. And so it's really that mechanism, that standardization, all the way from sort of the front end, finding the customers, through the loan origination process, through the servicing process, and then attaching that funding mechanism to this sort of more standardized apparatus that we think creates the preconditions for scale. And we've taken that.
Patrick, I just was going to break in to try to move it to this thing that we've promoted in the brief all week, and that hopefully we can just very crisply and simply lay out the community recovery vehicle that you piloted in Chicago and that you're now trying to ramp up more broadly. So without again, people are on the questions I noticed are asking, like, how can different kinds of investors get involved? What kinds of capital is needed? If you can very kind of simply in plain terms just say what the possible solution here that you guys have been designing is.
Absolutely. So the model really came to life first in Chicago, this sort of recovery type model. And it's really all of those elements I just discussed. So multiple local originating CDFIs, taking applications through a single front door where we're aggregating then the data, which is a huge component. I mean, Bruce, that was, one of the areas I think you were looking to address. Taking all of those applications through a front door, created a standardized loan product that all of the CDFIs have agreed to originate. And then on the back end, developed a special purpose vehicle that then was purchasing the loans from the CDFIs, and to Beth's point, mitigating any additional pressure on their balance sheets, but allowing them to continue to lend. So that's really the core model, is introducing the standardization, introducing a way for investors to participate on the back end as a result of the standardization, and then introducing a single, easy, delightful customer experience for the small business on the front end in terms of applying and being matched to one of those local originators. That's really the core of it, David.
Great.
And David, sorry.
Beth, before we do that, I want to come back to you, but let's just bring in James for a little bit of a reality check of the real world of CDFI lending. James, are you unmuted?
I am.
Just tell us briefly, like, what you are seeing among your borrowers, and then also what your capacity constraints are that might be eased by some of these ideas.
Sure. Thank you, Bruce. So I'll begin by commenting on Patrick's statement with regard to our ability to do marketing. That is a luxury that CDFIs do not have. We are in typical not-for-profit mode every day, trying to fundraise to make sure that we have the capital available to provide the much needed support these small businesses who are fragile need, particularly those small businesses of color. And so many of the financial institutions kind of align themselves with capital that they can demonstrate impact, which means loan capital. Our balance sheets, our expense base to be able to provide these services just cannot support that level of capital. We need other forms of capital that can support the CDFI effort. So I wanted to, kind of make a point there. Sure.
Can I just break in, James, because this has come up a few times, and I'm not sure that folks understand it. And I always say, as a journalist, explain it to me so that I can explain it to others. But this balance sheet problem. So literally, you can't support the more loans because, as a nonprofit, you don't have what on your balance sheet? Enough. You don't have equity because you're a nonprofit, right?
That's correct. So the net assets is really kind of the driving indicator about your leverageability. And so from a very healthy perspective, when you start to get leverages that, are south of, 4 to 1, 5, I mean, you become so diluted, and lenders become concerned about that as well. So your limitations is there. So the net assets and the equity component is really a restrictive component of our platform. I will add, particularly, if I will here, Bruce, in this context, when we're talking about the small businesses and communities of color, we know, and to one of the comments earlier about data, that FEMA knows, and FEMA statistics, and you guys are probably all familiar with that, through disasters, 40% of those businesses never reopen. And the 60% that do, and 2 years later, only 1/3 of them remain open. And so you can overlay that with communities of color, small businesses, owners of color, And I would tell you that that number is even more disparate. And so there's a double-edged sword there, and I'm getting back to the balance sheet question. There's a double-edged sword there in that we lend to these small business owners that we're talking about. They're on our balance sheet. And so in this crisis where we're seeing availability of capital and small grants to support TA and related things, the real essence and support that's really needed for CDFI is give us shock absorbers on our balance sheet, because in fact, we've been lending to those borrowers. And if those stats come true, our financial health will be at jeopardy.
So it's both your borrowers and then it's also yourself. And again, do you, if you had more balance sheet capacity and you could make more loans, do you have borrowers who could take advantage of that capital, reopen their businesses, rebuild their own revenues, and presumably repay you as well? I mean, is there a business here for you?
Yeah, CDFIs, and I think it's come to light here, have historically played a very valuable role in underserved communities. We get the trust. We know those communities. We walk the streets. We know those borrowers. They know us. There's a trust factor that exists well beyond what a traditional financial institution can provide for them. The challenge there is that from a capacity standpoint, we've not invested in our infrastructure. So the demand is there, and now that we're getting it, and so now I'm finding myself trying to figure out, okay, I got to enhance my systems. I need new delivery mechanisms. It's not necessarily bringing on staff. How more efficient can we become as a CDFI? The demand and need is there. Our ability from a CDFI perspective, given our historical state and given the magnitude of this disaster, is really stressing us from a capacity level. Look, the PPP program, while it started out, pretty robust, we're seeing now, because the window is still open, the dollar amount of those loans have come down substantially, but the volume has increased. And so you've got to fund and you've got to close these. And so when you're processing, 200 loans, and you've got to have the capacity around making sure they close and get funded, is stressing the organization. And so that's a good example there I wanted to share with you.
Great. Beth, you want to just recap a little bit about what this capital stack that you guys have been designing and what kinds of capital can play in it?
Yeah, absolutely. And just to put a fine point on this balance sheet issue, because it is critical. Traditional banks get deposits. Those deposits they can leverage 10, 20 times to do new lending in communities. CDFI loan funds that are not banks don't have deposits, and so rely on their equity, their net assets, to leverage new lending in their community. That can, because they are nonprofits, they cannot go to the market and raise equity. So they have to get that money either through retained earnings, which means profit, which a lot of them don't have because they cannot lend at rates that give them a profit, or through grants from either a foundation or the government. And those, as we all know, are limited. And so that is the only way they can raise equity. And once they do raise that equity, they can only leverage that 2 or 3 times, unlike a bank who can leverage it 10, 20 times, as I mentioned, because of restrictions from their lenders on how much equity they need to hold on their balance sheet against the loans that they raise. So when we talk about balance sheet constraints, what we're talking about is the dollar that is provided them in loan capital just doesn't go far enough to meet anywhere close to the demand that we're seeing in the market right now. If you take CRF's experience in Chicago, CRF and Axion's experience in Chicago, they got 11,000 applications from businesses for more than $300 million just from small businesses in Chicago with fewer than 50 employees. If you extrapolate that nationally, the need is at least $20 billion. The CDFIs out there, like True Fund and others, right? The average balance sheet size of a small business lending CDFI is around $20 million. So that's the capacity that they have. So if you put another $1 million on the balance sheet of True Fund, they can leverage that maybe 2 times, maybe 3 times. Is not going to come anywhere close to, no offense to True Fund, they're doing incredible work, but not anywhere close to the demand that we're seeing in the market for this kind of access to credit from small businesses. And so we have to think differently. We have to think beyond the balance sheet of these organizations if we're going to get anywhere close to meeting the access to credit needs that we have right now. And to be honest, that we've had for decades, right? These communities have had access to credit gaps forever. It's just exacerbated as businesses with no cash reserves are trying to comply with new federal regulation around, or state regulation around PPE needs and layouts and hand washing and store washing mechanism, all these things that take money to invest in to reopen. And then they're going to be coming into a recovery period where their revenues are not going to get back up to quote unquote normal for a long time before people are allowed to, feel comfortable going out, likely till after we get a vaccine. And so that means that if those businesses do not have access to credit, they will not be able to retool, they will not be able to reopen, and they will not be able to recover. And so I think that's what we're trying to think about. How do you think much differently about scale? Because we know the demand is there, we know the need is there, we know the pipes are there, but we have to provide new tools to leverage those pipes. And so what
let me stop you there and just give let me give my try at this, because I've been looking at it over the last week as we've been talking. So this new recovery vehicle will buy the loans from the CDFIs, thereby taking it off their balance sheets to resolve the problem you've been talking about, letting them then make new loans, and then this entity will hold the loans in a way, and this entity, the community recovery vehicle, could be scaled up quite extensively, will operate, as Patrick was describing, as a national network. So therefore, instead of having to solve the balance sheet issues for each individual CDFI, you're solving it more at a national network level. And that what it's needed, and this is the part I wanted to make sure everybody understands, is there's a certain amount of risk capital, call it equity or first loss guarantees or what have you, at the bottom. That is a kind of catalytic capital. Deborah Schwartz from MacArthur is our catalytic capital expert. She'll come on in a moment. There's a sort of junior debt, lower risk, but also lower return in the middle, and then a kind of more regular commercial bank, maybe CRA kind of money at the top. So there's a nice capital stack. Needs some catalytic capital. Could be foundation, could be public. In Chicago, yeah. I believe it was the city.
Yeah,
do I have that essentially right? And I do want to bring in the other folks before we run out of time here. So if that's close, let's save the details. Okay, I appreciate it. Sorry, Kat Berman. Quickly, I think C-Note has been a leader in trying to expand the capital available to CDFIs. And also, I think in trying to collect data on how it all works. Are you off mute, Kat?
I am off mute. Yep.
Just how does this system? How does C-Note plug into this system?
Yeah, I mean, first of all, I can't echo and support more everything that's been said today. Specifically, I think there's three themes. The theme of intentionality. Let's all be clear. Dollars are not getting to the communities that need it the most. And so that wealth gap that we stepped into is being exacerbated in our very eyes, in front of our very eyes. I think second is the need for infrastructure, right? Whether it's marketing, the back end, great connected capital work that the CRF is doing, and the front end as it relates to better connecting to investors, all that info is critical if we're really going to get to that third piece, which is scale. And I think it's been said in many different ways, there's outsized demand happening right now. So how do we really address that thoughtfully? Our role at C-Note has always been technology. So having been big fans of the CDFI industry and really wanting to see this 30-year-old proven industry get to the level of import and investor interest and access that it deserves. For us, it's about building the technology pipe. So we've spent several years, as you know, really creating that back-end infrastructure to make it easier for investors to identify CDFIs, support CDFIs, basket CDFIs by place or by theme, but most importantly, just the tech to make it easier at scale. And so I think when we think about where we're all moving collectively, this effort brings in that necessary discussion around balance sheet limitations, as well as, I would say, this secondary conversation that's as expanding new investor bases, right? We've traditionally looked at government and foundations as some of the critical investor bases for CDFIs, and I think it's time that we expand that, right? If we're talking about an equitable and a scalable recovery, this is a role each of us has to commit to playing, and that means communications, that means donor advised funds, that means individual impact investors. It pretty much means everyone on this call. And so how do we step into this and really support this industry at such a critical time? So we think certainly collaboration is a key piece, but also data, transparency, and building those scalable pipes is a necessary part of it.
Terrific, terrific. I hope you can stick around. As I said, we're going to keep the Zoom line open. But I do want to bring in Darren Williams from Southern Bancorp. Darren, are you on?
I am. Thanks, David.
We made you an agent of impact a few weeks ago because you guys were heroic in scaling up, as many CDFIs. You actually were sort of the poster child, as it were, for the CDFIs that really worked very hard, very quickly to get the PPP loans out. And I know that there's nuances about for-profits and not-for-profits, but basically, what are you seeing in terms of being able to really ramp up and meet the need?
Yes, so thanks, David, and thanks for making Southern an agent of impact. So just to be clear, there are a number of different CDFIs, and so what you've spoken about most of the day are loan funds, and that makes up the majority of the CDFI market. We have a CDFI loan fund. We also have a CDFI bank and bank holding company. And what I'm going to talk about is the CDFI bank. We are regulated just like any other commercial bank in America, and we have different sources of access to deposits, as you talked about, to be able to lend. So what we've seen in our market, we represent, we serve the Arkansas, Mississippi Delta, one of the most persistently poor communities of all the United States, where it's been generational poverty that's been backed by long time slavery that's caused the income inequality in the communities that we serve. But in these markets, we've done over 1,200 PPP loans, and for a total of about $110 million. The smallest PPP loan we've done is $200. The largest is about 4.9 million in round one. We actually made our first PPP loan the day the program opened, when big banks were saying, we don't know what's going on, we're not doing it. We did not limit ourselves to not just our customers. We continue to accept applications. We're getting about 10 a day. The volume is completely dissipated, which compared to what it was earlier. But our average loan size here in round two has gone down tremendously. Average is about $44,000, and that's with a couple of really big loans. For the last, say, 300 PPP loans we've done, the average loan size has been less than $15,000. And round one, where we did 553 PPP loans, over 75% were for businesses that had less than 25 employees. And I mean, we were, the vast majority, 336 of that 503 were for businesses that had less than 10 employees. So we think we're reaching the very, very small businesses that need access to this capital. And it's been the lifeline. It's been the lifeline for these small businesses, for the employees that now can, pay rent, can buy furniture, buy groceries. So it's been a tremendous benefit for these communities. We're now concerned about the rebuilding stage, as some have talked about, as we move forward, because the PPP really is a way to keep your employees working. It's not necessarily a way to keep that business open. So there are going to be challenges for our borrowers as we move toward this rebuilding stage.
Terrific. Let's just we're at the top of the hour. I hope you can stay on for a few more minutes. Deborah Schwartz, you get to bat cleanup here. You've been involved with the CDFI movement for a long time, been very helpful to me in understanding it. What are your takeaways? And what people seem to be asking on the questions are, what can impact investors do now? So if you could frame it in the sense of like, where can people take action?
Right. This is an amazing experience, and thank you, David, Dennis, and Amy, for bringing such an incredible group together. But I'm watching the little number count by participants on the bottom of my screen, and we hit 1 minute from the top of the hour, and then I'm
sorry, Deborah.
So it's very dramatic. I feel like I'm playing some kind of weird video game. So I have to get on another call, so I'll offer a few thoughts. First, I want to really thank everyone that did share their perspective. It was fantastic to hear Bruce framing things, as he always does, in an incredible way, very cogent, pretty alarming, but also a kind of rousing call to action in some ways. I want to because you asked me to share takeaways, David, there were sort of 5 things that I heard, all under a big umbrella of reinvention and rethinking. So I think that really came through. And I think Bruce said It's not just about products, it's reinventing. We heard people talk about integration as one thing. We have to figure out how CDFIs integrate better to other parts of the economic development ecosystem. A second thing was collaboration, and Patrick really called out something that's been very visible to us to see all of the rapid partnering that's gone on among CDFIs. So integration, collaboration. Infrastructure was another thing I really heard again and again. And James, you talked about how it's tough to try to retool that infrastructure on the fly. And Beth, I know I've heard you talk about infrastructure and systems. And Bruce, you mentioned that as well. And I was really intrigued by the idea of some kind of future where CDFIs are helping small businesses do their back offices together and just reinventing what infrastructure looks like for all of this. So the other piece is policy, which, you know, Fran helpfully put on the table, and that we can't ever forget, because if we really want to get to scale, we must have a policy piece that works. And I think my last item is data, which is where we kind of started. And I think that just can't be understated. 20 years ago, MacArthur and Ford and the Treasury Department funded something called the CDFI Data Project. And its whole purpose was to try to help us understand what was going on in this field so that we could advocate more effectively for funding and other kinds of policies. I think it's still very challenging to put our arms around the story. So Darren's got amazing data on what Southern is doing with PPP, but do we know, for example, what the total volume is of PPP loans originated by CDFIs? I'm not sure that we do. Just hearing this conversation and knowing things about our own portfolio, I know it's at least $1 billion, but I don't know if it's 2 billion. And we don't know exactly who they were reaching, but we know anecdotally they were reaching the businesses that mainstream banks were leaving behind. So data, I think, is going to be a huge part of the future. And as far as where impact investors go, I would just leave with this thought. Catalytic capital, which you mentioned, David, is a way of doing impact investing that makes a lot of sense when the world is totally uncertain and full of risk. That's what it was built for, to be flexible, to take risk, to be patient, because we are going to have long horizons for our lending and our investing. It can be used to seed things. So the pilots in the different cities need catalytic capital to seed them. It'll be needed to scale organizations during this period, and CFIs are doing more than ever. And I think the other thing which Beth flagged is it's needed to sustain. The business model of CDFIs as we have it leaves a gap. It costs more to deliver the high touch fill in the gap loans than you can earn from the interest income. So that's why we have the CDFI fund. That's why we need policy. Because impact investors by themselves don't actually represent enough scale to do that sustaining work. That's got to come because this is a public good, as Beth said so aptly. And the last thought I would just leave with is, it's one thing it's kind of easy to lose sight of in all of this CRA, securitization, all our different kinds of things. We are talking about institutions. CDFIs are institutions, and they become the backbone of communities that they serve. And building institutions is a long process. It doesn't happen overnight. And as you said at the beginning, and Amy, I understand you said, you know, this is this overnight success that was 30 years in the making. MacArthur, Ford, we started investing in CDFIs in the 80s and 90s. Southern, IFF, CRF, Calvert, LISC, lots of CDFIs. And it took not just our investments, but many, many other investments and long years of leadership to build the systems and build the institutions. And that's why they could deliver on PPP like this. You know, if Southern hadn't already been built, they wouldn't have been able to turn on the spigot on day one, because you couldn't build that capacity in one day. They had to be there for the long haul. So I hope, if anything, impact investors will take that long-term horizon and that institution building perspective to heart, because that's what we're going to need as we go through this whole next wave. And I'm hopeful because there are some big ideas here to reinvent and to make things a lot better. So if we can crack the equity nut on CDFIs, that'd be pretty exciting. So,
terrific. Thank you, Deborah, and thank you to all of the speakers. As you can see, we tried to do a lot. We went a little bit over here in terms of the hour, but if you can hang out, and I wanted maybe the way to kick off the hangout, we'll close up the official portion. But Beth, I know I cut you off, which I apologize for. So, and you can probably correct my my attempt at summarizing your project. So maybe if you want to just if you just want to hold forth, and as some people obviously will leave, but we can just chat. And I don't know how this is going to really work. It's a little bit of an experiment. I think people can take themselves off mute and try to pipe up, or they can. I think you can raise your hand in there is a in the Zoom as well. But anyway, if you can hang out, and we'll see how this works. But Beth, maybe if you want to keep going and clarify anything I might have messed up.
No, you're good, David. I won't spend time on that. I'm going to put my email address in the chat so folks can reach out if you want to learn more. I'm happy to provide additional information, materials, so that we can keep pushing forward. In the meantime, I thought I would leave us with, there is some data on CDFIs in round 2 of PPP that is doesn't include round 1, but in round 2, 302 CDFIs did 50,492 loans for $2.7 billion, average loan size of $54,000. And so I think it's critical. And that's just for PPP. And I think what we have been stressing is that PPP has been an incredible government program to support these businesses. We all know it needs reform, but it's been a product that has been pushed through these pipes. But as we've been saying, that 2.7 billion is incredible for these incredible amount of volume for these CDFIs. But there was $650 billion of allocation. So, just to get a sense of scale, I think there's a lot of work to do to keep pushing that forward. So, I've been energized by the conversation, excited to continue thinking about solutions in, like everybody has said, massive collaboration. I think none of us can get anywhere close to doing anything meaningful alone. And so really trying to find the strengths of all organizations, putting them together to row in the same direction to try to attack this problem immediately and for the next 30 years, because we know it's all needed. Great. So I'm actually going to have to jump, but really appreciate the conversation. Sending my email address right now, and look forward to continuing the conversation.
Terrific. Thanks, Beth.
I wanted to call attention to, speaking of the parallel system that Bruce talks about, and Deborah closed talking about innovation and infrastructure, but there's this whole network of sort of emergent small funds that are focused on very local businesses run by people of color, by natives, by women, all of the most left out communities. So I'm thinking about funds like the Runway Project, Boston Ujima Fund, Real People's Fund, Boston Impact Initiative, but there's really a lot of innovation happening there. They are shifting power to community members. They're creating investment tranches that allow community members to participate, in some cases with as little as $50. And they also flip the investment terms, so they're favoring, giving the more favorable terms to the most vulnerable investors, and those that can take more risk may pay or get a lesser rate. So it's a really interesting and I think vital set of capillaries. But talk about fragile, right? These are very new. There's a fund, the Olamina Fund, Candide Foundation's fund, is supporting some of these new organizations with funding, but I think we need a lot more of that. I think they're doing great work. They're very innovative, but there's not a lot of support behind them. And if CDFIs are fragile, these guys are super fragile.
That's very important, and I will say Amy's been terrific. She has a you may know her as @Locavesting on Twitter and other places, and had a terrific publication called Locavesting, which we noted for many years, and then eventually tried to recruit her to Impact Alpha last year. There's a few folks who we've been chatting with over the course of the week that kind of cold calling, Thomas Venin from 18 East Capital, Andrea Armeni from Transform Finance, Rachel Riley from EIG, Adam Conacher from Rockefeller, Jacob Haar from Community, I always get this wrong, Community Impact Capital, what is it? No. Sorry, CIM, I think. If you're still on and want to hold forth, be our guest, and anybody else as well. Don't wait for me to call on you. I think you just take yourself off mute and start talking now.
Yeah, hi, David Thomas here. Can you hear me okay?
Yeah.
Yeah. No, look, it's well, as you know, we were discussing a specific angle on this issue. We tend to look more at emerging market, but certainly we think that the conversation is akin to the one around CDFIs. And I just wanted to react to points made by both Beth and James around strengthening and freeing up CDFI balance sheets. And I think someone in the chat mentioned the use of guarantees, and we certainly see this crisis as an accident, as a disaster, and the best way to, we think, protect these crucial intermediaries is to provide insurance, and the reality is that we know how to do that, to provide credit insurance to intermediaries. Now, obviously, when you know that the accident is about to happen, it's a very strange moment to provide insurance. But because we are impact investors, surely we shouldn't just stop doing the right thing because it's not the usual thing. And we do believe there are a number of very straightforward and very importantly cost efficient and reasonably quick to deploy tools that can be utilized to essentially take risk off the balance sheets of CDFIs, allowing them to do more, of course, but also just to weather the storm. I think what Jem said about the fact that their clients are going to go through a horrible patch, and that will put their own financial stability at risk. And so the first order could be perhaps to just make sure the CDFIs are still there on the other side of this.
Yeah. Just so people know, I think you're coming to us from Cape Town, no?
That's correct. Yes.
Yeah.
So it's a bit later here.
Anybody else
This is Laurie,
want to pipe
Laurie
up?
Spangler.
Oh, hi, Laurie.
Hey there. I just wanted to share two things, picking up a stream in the chat about local and the theme of place-based investment, and then how do we reconcile that with the notion here of aggregation for the whole community. And we're about to publish a paper. I've had the privilege of working with Darren at Southern for the past couple of years on their last capital campaign that concluded pre-COVID. And we're just about to produce a paper that talks about some of the insights and lessons learned. And this was a capital campaign for equity, for that equity. And because whether you're a loan fund or a depository, the equity is what you really need, as we've talked about in this conversation. And I would just say on the place-based, people are asking, why doesn't that resonate? Maybe it'll change, and I'm hoping that this initiative will help us change it. But we found for the banks, who are, as we talked about, a big contributor under at least historical CRA, it's all about where they see their own geographic footprint. So Southern operating in Arkansas, Mississippi, just frankly not relevant to a lot of these guys, just saying not relevant, even though high-performing institutions, so that was the bank's reaction. Institutional investors, it's just too far away. So it is, again, Arkansas, Mississippi, these are not visible markets. They are not visible communities. And it was very difficult to get them to even react. And self-identified impact investors, I got to tell you, although they understood the place-based, they went the opposite end, hyper-local. And they've picked their places, and they've picked their places in advance, and there wasn't a willingness to look at Southern straight up. Now, with those three barriers, I got to tell you, every investor to an investor who visited, the Delta, who came and visited us and went on a tour of the communities, every single one converted and came in to the deal, every single one. But getting somebody to come out, travel, take the 3 days to drive around the communities that Darren and team serve, is a big investment for someone to make. So there's some lessons there about how do we bring that place. I'm using Southern as an example of the broader principle, obviously, but I think this aggregation notion is really where we've got to contribute our efforts, because it's just too taxing on an individual transaction basis to get that capital singularly. So I just applaud where we're going here as a community, but I'll just tell you, the place-based, let's not just assume it comes to life for people. We've got to make it come to life for people.
I will say that just speaking of place-based coming to life, I met Darren down in Clarksdale, Mississippi, and so have always had a soft spot in my heart for Southern and for Darren, because it's an amazing place to visit. And it's people know it as sort of the birthplace of the blues, and it just infuses the whole place. And so you can't go there and not come away thinking, oh, this is a place that you'd love to see, finance its own revival. I did read, I think recently, that, because it's become so tourist based because of the Juke Joint Festival and whatnot, that it's been hit super hard. So, hopefully Darren and his team are playing some role in helping out there.
Hey, David, this is Darren, and I'm going to have to jump off as well to get on a call with the Federal Reserve. But one, I want to thank Lori and thank you for visiting. Anyone else who'd love to come visit, we'd love to have you and give you a tour when we're back open for business. But you are right; those communities that rely heavily on tourism, they're struggling right now, and we finance a lot of those businesses. They are struggling. And Lori made great points about the difficulty in raising equity capital for banks. I want to just make one other thought to your network here, particularly about depository CDFIs. Your deposits in a CDFI bank, they are safe, they are sound. We are a regulated institution. They're just as safe as they are in any other bank, but they're having outsized impact. And as Beth made the point, we leverage those deposits 10 to 1 at least. And so I would encourage you, as a way to maybe step your toe in the water of investing in a CDFI bank. If you're not ready to go all in with equity or PRI, your deposits in a CDFI depository are very impactful as well. And I'm gonna have to jump off, but I really appreciate you having us, and thank you for what you're doing.
Somehow it makes me feel better, Darren, when you say you got to get off to go talk to the Federal Reserve.
They've invited us to be a part of that Fed Listens today, which starts in 5 minutes. So I better jump off.
At least it's not Fox News.
It's not.
Good luck, Darren.
Thank you.
I think there's a St. Appleton in South Africa who raised your hand. If you want to jump in, just make sure you're off mute.
Thank you, sir. How are you? How's everybody? Sure.
There you are. Good. Hi.
Yes, sir. Can you hear me?
Yes.
Yeah.
Oh, okay. Thanks. Okay, thanks for this opportunity. We are coming from SMMEs and cooperatives within the integrated aquaculture space. So yes, here in South Africa, it's easy to set up a CDFI through your Reserve Bank and the treasuries. But helping the poorest of the poor to come from the ground is very, very, very difficult. So how can Impact Alpha, come together with us to take our poorest of the poor, in our townships, to, whereby, treasuries and reserve bank can come in and take our people to a higher level. Please, I see Thomas is coming from Cape Town. Please, let's keep in touch. Let's see how we can help one another, brother, please. Thank you.
I'll send you my email address just now, or I'll wave at the window, see if you can see me.
Yes, I've just taken Beth's email, and I think it's based, and so those are the people that maybe I will get everybody's contacts from. I think.
Great. And there is a fairly vibrant impact investing community, I know, in South Africa, and Thomas could help you. The Bertha Center at University of Cape Town could help connect you as well. And please do keep in touch with us and let us know what we can do. Anybody else? Any other hands up, or folks who want to jump in?
David, this is Dennis. Hi,
good. Dennis Price, our colleague at Impact Alpha, who I'm sure you've all seen his byline. And
Kat at C-Note mentioned some ways, and Darren mentioned your deposits at CDFIs have impact. And I'm wondering, other folks on the call, and I know Bruce and Deborah agreed it wasn't just about product either, but like what are the ways that retail investors can participate in this relief and recovery, or just sort of broad, longer term community development efforts? How do we get our own money in reasonable amounts into communities? Anyone have any recommendations, specific products, strategies, etc.? So also obviously growing personal interest of mine as well. So happy to hear anyone who's taken that journey or has some ideas.
I have money in C-Note.
C-Note, which goes directly to
CDFIs, right?
Yeah, and we do both deposits and loan funds. So one of the reasons we realized technology not just helps get money more efficiently to loan funds, but that, to Darren's fantastic point, now is the time to really be moving deposits in banks and credit unions as well, working at some of the most at-risk communities. I give a couple other examples as well. So CDC Deposits works with communities, not many CDFIs, but still several strong community banks, and as well as Calvert Impact Capital Partners. So I love the question, and I agree with you. I think it really is a fantastic time if you're not working with the CDFI. The last thing I would say, because we've heard it so important and often on this call, is grant. It's a great time to be calling up your local CDFI and asking, what can I do to help?
Because a grant could become that kind of sort of equity layer that could leverage into more and more loans.
Operating capital helps them. Yeah, it's needed on many fronts.
Yeah.
There was also some chatter on the chat about equity crowdfunding. So there are sites like Honeycomb, Mainvest, which focus on like real Main Street mom and pop type businesses. And then there are sites like WeFunder, which is terrific and has a wider range of businesses, but they've all created COVID relief and recovery loan products that have lower fees for the businesses, and anybody can invest in that.
May I jump in?
Certainly.
Sure.
Yeah, so, well, thank you, Amy, for shouting out BII. I'm a member of that cohort, and a few of us were on, and I'm more of a deal guy historically, so I just like innovative approaches, so that's been a space for us to practice. But one of the things that has come up there, as well as what I've reflected on, I think I put it in the chat earlier, is, I came out, I often called myself a recovering merchant banker, right? So when you think about that world and the structure and apparatus, you look at stuff like the CFA and the Association for Investment Management and Research, which basically is the industry standardization for how we think about all, Wall Street publicly traded companies, right? So when I think about the continuum of impact investing and conscious capital, right, of which CDFI is a part, the blended capital funds that we're innovating and experimenting with are, to me, there is no standardization of how we think about that stuff. When we talk about, whether it's true cost accounting or ESG stuff, right, or the sustainable development goals, how can we get standardization across, like-minded but diverse approaches to these problems if there's no body that affirms the apparatus and scalability of these varied myriad of products that could be integrated eventually on a shelf? And I think about Michael Tanzi's work in the book he wrote around CDFIs in the capital markets. But I would be remiss if I didn't bring that, because I think we're all trying to be creative from the places that we sit to solve the problems. And this moment allows us to recreate. So my question after all that long preamble is, are you all thinking about that as part of your work, the standardization? I mean, clearly you're talking about standardizing products and integrating and collaboration, but part of that is looking at this entire larger ecosystem and saying, look, there's a new way to do business. The conscious capitalism folks have been documenting it. You all have been documenting it. We're doing our part in blended capital, which, as you said, is relatively new. But there is a larger continuum with which all of that fits, and I don't know who's speaking to that.
Interesting. I mean, that's what Bruce Katz was sort of hinting at as well, and I think there's a lot more work to be done to sort of fill out what the elements of that are. I know. I mean, what I learned a lot in the reporting out of for this call was the CRF platform, which I hadn't really been aware of, which is a tech platform again that, like, sort of to Deborah's point, had been built up over the last 10 or so years. I think post Great Financial, the last recession, which does provide some of the sort of infrastructure that can roll across multiple institutions. Other folks have thoughts about sort of the broader network, broader infrastructure, common basis. There's people popping up about accounting rules, Just to that point, I mean, we see it ourselves at Impact Alpha. A lot of stuff comes in. We try to keep it straight to sort of understand how it relates. How the different parts relate. Somebody popped up in the chat that she had seen the ERIS CDFI rating tool. I think that's Lisa Dyson on Impact Alpha. So, at some level, information is part of the infrastructure as well.
Right. I'd like to hear from Dorothy Adams. Dorothy, if you're on, because you've been commenting a lot here, but also on our Slack channel. And I know you're doing some interesting work in Connecticut with, collaborating with other CDFIs and creating funds. Not to put you on the spot.
I think she just left.
Oh, she might have just left. Okay.
Okay. Well, we've got down to the final 64 here. It's like March Madness or something. But unless folks want to keep going, we can close it up, or we're happy to hang out. This was, as I said, a little bit of an experiment just to see whether folks want to have the opportunity since you're all here. Is there anybody else who's gonna jump in?
Just want to say thanks for having us, David and Amy. This is fantastic and a really important and timely conversation.
Well, Kat, thank you.
Great.
Take care.
This
Good
is
to see you,
Can
too.
I just say one thing?
Sure.
David, is there a way, there've been a lot of really interesting things talked about, but also in the chat box. Is there a way to capture that and share it, the things that have popped up in the chat box, so they're not just go flying off into the night?
Well, excellent question, Betsy. It's almost like you set me up. For starters, we will. I'm told we can share the chat. There also are these personal, one-on-one messages back and forth. So we're going to have to strip those out. But we'll share all the resources and questions and whatnot. Yeah. But this is the open space technology challenge, actually, which is how to keep it going. And so the best way to keep it going is in the Slack channel. We know that's kind of been difficult for folks to, have multiple windows open and multiple, everybody's getting messages on every platform. We understand all that. We're right in the middle of that as well. But our best effort so far is to roll it into the Slack channel. This one happens to be called Community-Capital. So you can see in the brief and other places how to join up, and we'll do sort of all of the above. We'll distribute the chat from the Zoom call, and we'll also plug some of it straight into the Community Capital Slack channel.
Great, thank you. This was terrific.
Thank you. Last call here. Bar's closing.
Betsy, if you go to your chat, the three dots on the right, you hit save, it'll save to your laptop.
David, I have a question. If you don't mind.
Anybody can save it themselves. I didn't quite realize that. Thank you.
Oh.
Sorry, I have a quick question, if you don't mind, David. I think a couple of folks mentioned the need and the opportunity for new products, and I was wondering if anyone had anything specific in mind. And I mean, by that I mean client-facing products. I understand that internally we can have other sort of like products and services that we do from like an investing perspective, but I mean, particularly from CDFIs and particularly for small businesses, what's there other than loans? Forgivable loans, deferments, is there any innovation in that sense from like the client-facing product that is conscious and flexible?
Well, I will say, Manuel, that you, if we had that question, you would be one of the ones we would actually call and ask that question too, because you're at Self-Help, aren't you?
Yes, I am. Yeah, but we're trying to figure it out, and that's why I was wondering if, given that it's such a global, I don't know, I was trying to pick people's brains, see if, I don't know. I think in that sense, being also sort of self-critical, I don't think we've been as innovative as we can be. I know that we try, I know that we constantly try and figure stuff out, but we continue to fall down the path of sort of traditional lending and that kind of thing. And hopefully this is going to push us in the direction of more innovation in that sense. So I wonder if we can take a leaf out of other sort of industries or whatever.
I think that's a terrific topic for another call. And what we've been, and we probably didn't dig in deep enough on this call, is what kind of capital actually will meet the needs of businesses. Mm-hmm. So as I, as somebody mentioned, the PPP kind of kept the payroll together for a sort of very short time. But now as folks open up, they've got a restaurant's got to redesign its floor plan, and you got to have a new cleaning service. You've got to have, now you're, doing more takeout. So you need an online, component. There's all kinds of things that, and at the same time, you got to invest in all this new stuff. All your revenues have been, cratered, for the last 2 months, so that you don't have any money left. And so will folks lend to you? Is it a good loan to make? I think we don't really know how it's going to play out. So I think you're right about what are the new products that are not just maybe grants, but not loans that you basically may not be able to either qualify for or even necessarily pay back. Any other folks have any specific thoughts on new products for businesses and I guess nonprofits as well?
Well, I just want to jump in here, since there's been a discussion during the School World Forum, where any of you tuning in, it was all virtual, just nearly 2 months ago. And what I had tried bringing up in some of those sessions, especially those related to community finance, is the notion of, so given what's happened with the pandemic, given the loss of liquidity, that how viable may it be to have some form of a mutual insurance mechanism, perhaps modeled after, if you're familiar with either building size in the UK or a variation on the Sparkassen in Germany. Actually, the latter has been a case study in the Center for Public Impact, one of their case studies. You can look them up on the concept of Sparkassen. And secondly is real assets that could even be possible. So you're speaking, Emmanuel, of products for consumer side, but how about even being able to direct funds to things like community infrastructures, such as transit or even a park space or any nature-based assets, just you name it, anything that helps improve vitality of community and economy. So those are just 2 lines of inquiry that I'd like to put out as suggestions for future chats, and also to continue in the Slack group as well. And right now, just any additional responses. So Manuel, do you have anything to add to that?
It's probably beyond me in that sense. Like I honestly don't feel equipped to answer your question. In my mind, I was thinking more taking it to answer sort of myself and divert from your question, because I can't answer it. I don't think I can answer it. I do think it's, mind you, I will say yes. In my mind, though, it's more like the longer term approach. It's more about, when you were talking about that, I was thinking resiliency. I was thinking, yes, if one thing this has, I think, amongst other things, transpired is businesses are not well equipped, from big corporate airlines all the way to your local grocer down the street. Like no one's equipped to survive this sort of thing. But even this sort of thing, 2-3 weeks, a month worth of not getting income or whatever. So I think you're referring to like the broader infrastructure in the longer term and
correct,
providing the, yeah. And but I still think that's long term. I'm still thinking of the emergency at the moment. So I was thinking, what if we could take a leaf out of the venture capital world with SAFE or revenue-based financing and something that's a bit more flexible, more riskier by traditional models, that as we hopefully start going back to the economy, we could allocate. I don't know if anyone's done that in the micro level, in the very small businesses that don't have exit events, that don't plan to do IPOs. And so can you repurpose those vehicles to the micro world while still keeping the flexibility and the risk portion of it without the growth? Anyways, that's what I was thinking as well in my I don't know if
actually just
I went down the rabbit hole.
Just look up this company. Just had a good chat with the CEO this past Monday called Epic Hub. If you've heard of them or have you not, they're based in the Netherlands, but they make investments around the world, and they're a venture capital firm with no exit required, that they're fully revenue-based, so their entire returns are based on a share of company revenue generation.
Young-Bo, you want to stick that name
Yes,
or the link in the chat, and just introduce yourself. Who are you with?
Oh, so my name is Young-Bo Du. I've been in various capacities around sustainability and sustainable development for the last 15 years, from research to social enterprise, and now actually, and especially thanks to this reset offered by COVID crisis, that now reflecting on my life's work of bringing impact finance into mainstream practice, mainly focused on real assets, given just to set you some context. And I think it's a storyline that I feel hasn't been told all that much, is that you have 400 trillion US dollars of wealth in the world, half in real estate, half in liquid wealth managed. And to reach those SDGs by 2030, 90 trillion needed, only a third committed to the loosest definition of pledge. And yet, if you count up all the infrastructure that needs expansion or replacement in the next decade, that's already north of 100 trillion. So there's no reason why we can't achieve those targets if we build those criteria directly into any form of new or upgraded infrastructure.
Stay tuned. We want to do a 10x infrastructure call very, very soon. So we'll be back in touch. Thank you to everybody. I think this. I don't know whether we'll let us know whether you think this hangout after the call worked, but I think at least let me kind of wind down. I always get very keyed up in these things, and then it's nice to hang out with you all for a bit and wind down. So I'm sorry we didn't get to have a beer together, but maybe in a future world. I think with that, Zulema, Dennis, Amy, everybody on the Impact Alpha team, I think let's call it a day, right? Thanks to everybody for joining.